Hello, I'm John Ward on behalf of Anglo Far East and Physical Gold Fund. And we're once again delighted to have with us here today Jim Rickards. Mr. Rickards is an investment banker and investment advisor based in New York and the author of the best-selling book, Currency Wars, The Making of the Next Global Crisis. Welcome, Jim, and thank you for joining us.
Thank you, John.
Well, Jim, it's been quite a week. Most commentators predicted that the Federal Reserve would announce a tapering of their asset purchase program, currently running at a modest $85 billion a month. That's to say, in layman's terms, they would give up printing funny money, or at least so much of it. Now, most commentators did not include Jim Rickards. You predicted in your last interview with us that the Fed would keep shoveling new cash into the economy. So, Jim, here's my question. Apart from the natural satisfaction of being proved right, what do you draw from Mr. Bernanke's decision this week?
Well, John, as you mentioned, I expected the Fed would not taper, and said that in a number of interviews and venues, including ours. But to me, it was a fairly straightforward call. You know, going back to last May when the Chairman Bernanke first started talking about tapering, he said, we expect to reduce asset purchases, that's so-called tapering. We expect to reduce asset purchases before the end of the year. But he went on to say, if the economy performs in accordance with our forecast. And the market focused on the first half of the statement and just assumed they would taper, but ignored the second half, which was it was conditional on economic performance. Well, two things. Number one, the Fed had a very rosy forecast, and anyone who's looked at Fed forecasts over the years knows they have the worst forecasting record in economics. They truly do. They've been wrong 4 years in a row, and they've been wrong by a lot. So the fact that the Fed was putting out a positive forecast meant that you should almost assume the opposite based on their track record. So that was the first sign that maybe they wouldn't be tapering. But then when the data actually came in, and the Fed, you know, there were statements all summer by the Fed presidents and so forth that, you know, Federal Reserve Bank presidents and members of the Board of Governors, that it was all dependent on data. And again, people glossed over that. The data was horrible. You know, the August employment report was bad. Consumer confidence collapsed. Mortgage applications collapsed, et cetera. So the combination of the Fed's poor forecasting record and hard data coming in well below expectations made it very easy to see that they were not going to taper. But, you know, the market just went on its own. It's a good example of what behavioral psychologists call groupthink. You know, once enough people said they were going to taper, it was easier for everyone else to say, yeah, they're going to taper. People were ignoring the evidence. So they didn't taper. So the question really is, where do we go from here? And it's sort of silly to see people already talking about October and December. They're saying, well, you know, the Fed didn't taper in September, so that means they're going to taper in October. Well, that's nonsense, because the basic analytical framework has not changed. Whether they taper or not will be dependent on the data. So instead of guessing, why don't we wait and see what the data is? You know, before the end, the next Federal Open Market Committee meeting is the end of October. We're going to have a September employment report. We're going to have more reports on PPI, CPI, consumer confidence, et cetera. So let's see what the data actually says. I don't know what the September employment report will be. No one does. But my sort of meta view is that the economy is fundamentally weak. We may actually be heading in a recession. So if I had to handicap it today, my expectation would be that, you know, the data will come in weak, and they're not going to taper in October either. But let's see where the data actually comes out. But it could well be that we get all the way into next year and a new chairman. And of course, everyone expects that to be Janet Yellen. I think at this point it's pretty clear that it will be Janet Yellen. We could get into next year and with still no tapering because the economy is underperforming. So I think that's the kind of the lay of the land. But let's just take it 1 month at a time in terms of the data. But it's an easy analysis. Just take the Fed at their word. They say it's data contingent, so let's see what the data says.
It's interesting you mentioned Janet Yellen. I believe she's on record as saying that in a slack economy, money printing at any level does not produce inflation. Do you think she's right, or do you see the possibility of significant price inflation in the relatively near future?
Well, I think she's wrong, but that's kind of irrelevant. What matters is she thinks she's right. And, John, just to be more specific, she gave a speech in April 2012. Of course, Janet Yellen is a fine academic. And by the way, her personal forecasting record's pretty good. She's been getting a lot of things right. But she said that there's no example of an economy experiencing much higher than expected inflation with this much slack in labor markets and industrial output. So she's looking at a dismal employment picture, declining labor force participation, massive excess capacity in industrial industrial capacity, and saying that there's just no chance of inflation. That's kind of what makes her a super dove, and she's sort of fearless when it comes to money printing. Doesn't mind keeping the asset purchases where they are because she's not worried about the Fed balance sheet and she's not worried about inflation. Now, where she's wrong is that inflation is not primarily a monetary phenomenon, as Milton Friedman said, and it's not primarily a function of excess capacity or slacking capacity, as Janet Yellen said. It's really psychological and behavioral. It depends on the velocity of money, the turnover, and how eagerly people want to borrow and lend and spend. And that's a psychological phenomenon that's not a pure function. It's only a partial function of money supply. And I would point to Weimar Germany in 1921. There you had the famous Weimar hyperinflation, which basically took the Reichsmark to the point where it wasn't even money anymore. It became litter. Well, there was a lot of excess capacity. There was extra labor and extra industrial capacity in Germany at the time, but they had hyperinflation anyway because of the behavior, because people just lost confidence in the money and dumped it and turned it over and spent it as fast as they could lay hands on it, and you could have that happen again. So I think the combination of Janet Yellen being the new chairman, Janet Yellen not fearing inflation and not worried about the Fed's balance sheet, combined with a psychological, behavioral dimension that I just mentioned, means that they could actually win this battle with deflation and cause some inflation. And if that happens, if you change the psychology and bend the velocity curve, it could really take off way beyond their expectations. So no doubt the Fed wants to see inflation get up to about 3%, but if it actually moves from 1.5 to 3, it could go right to 7 or 8, because at that point, the genie's out of the bottle. You've changed the psychology. It's not so easy to change back, and it could overshoot, and that would more closely resemble what happened in the 1970s.
Well, you mentioned deflation in that answer, and we know that, and you've pointed out that this is a graver anxiety in the Fed than inflation. How serious is the threat of deflation, and what would that look like? I would say for myself, and I think for some people, the picture of inflation is easier to see than the picture of deflation. Could you describe that and how likely it is?
Yeah, I think that's exactly right, John. There's something intuitive about inflation. When price levels take off, everyone says, oh, housing's going up, gold's going up. People kind of understand why asset prices, hard assets, increase in an inflationary environment. The deflation is much less intuitive. First of all, I do think deflation is a serious threat. I think the government, the Fed, Treasury, will do everything possible to avoid it, and that's why I expect inflation. But the deflation is there. I mean, what's going on in the economy right now is you really have a tug of war between deflation and inflation. They're both going on at the same time, and the price indices we see are really the net of two very powerful forces that are, to some extent, canceling each other out. The deflation is natural. It's what you would expect in a depression, which we're in. It comes from deleveraging, asset sales, reducing balance sheets, etc. The inflation is induced by policy. It comes from the money printing. If you had one without the other, if you just had a depression with no money printing, we'd have very serious deflation today. If you had money printing without a depression, we'd have very serious inflation today. In fact, what we've got is something closer to zero, about 1%, because the forces are pushing against each other. Now, I think inflation is going to win the tug of war because the Fed, deflation is their worst nightmare because of the debt to GDP ratio. In other words, when you have deflation, you can have a world where nominal GDP is actually going down, but real GDP is going up, because you have to get to real GDP. It's nominal GDP minus inflation. Well, if inflation is a negative, in other words, if it's deflation, you have to subtract a negative, which means you add the absolute value. So you can have a world of, nominal GDP going down 1%, 3% deflation, and 1 minus negative 3 equals positive 2. You could actually have real growth in a world with declining nominal GDP. Now, the real growth is good, but the declining nominal GDP is the Fed's worst nightmare, because what is that doing to the debt to GDP ratio? Well, we know the debt's going up because we continue to have budget deficits, but if nominal GDP is going down, that means your ratio is going up. That means we start to look more like Greece or Japan and risk a complete collapse of confidence in U.S. government securities and the dollar as a whole. So that is a nightmare scenario. It's very non-intuitive. I call it through the looking glass, when you have to, it's kind of seventh grade math, but it's just tricky enough. When you subtract the negative, you add the absolute value. How does that work? So it's not intuitive for people, but deflation is, you can have real growth in a deflationary environment and with declining nominal GDP. And Japan has had this from time to time over the last 20 years. It's a very strange world. The U.S. hasn't seen anything like it, actually ever. The last time we had deflation, it was so severe that we did not, that nominal GDP was collapsing even faster. We didn't have real growth. That was in the period 1920 1927 to 1933. So this has never happened in U.S. history, but it's a danger we're facing now. But precisely because it's so dangerous, that's what leads me to conclude that the Fed will move heaven and earth to avoid it, which means more money printing. They may actually have to increase asset purchases. Far from tapering, they may do the anti-taper. They may increase asset purchases to $100 billion a month if that's what it takes to get the inflation. So I wouldn't rule that out either.
Jim, you mentioned the dollar. Let me ask you something about the dollar. In a recent interview, you made a striking comment about the monetary system. If I can try to capture this correctly, you said that until 1971, the world was effectively on the gold standard. Then there was a short period of limbo, and then the world was effectively on what you called the dollar standard. But you observed that the U.S. government, if I got you right, since 2010 has effectively abandoned the dollar. That seems an extraordinary policy for the U.S. government to adopt. Could you explain a bit what you mean by that comment?
Sure. First of all, your summary is exactly right, John, and that is how I looked at it. You know, and the gold standard ended in 1971. We had a period from 1971 to 1980 was really one of chaos and muddling through and moving to floating exchange rates. But, of course, it was a horrible period of economic performance. The U.S. had 3 recessions between 1973 and 1981. You know, we all know the price of gold went from $35 an ounce to $800 an ounce. Inflation took off. The value of the dollar was cut in half. So it was a horrendous period. The dollar was rescued by Paul Volcker and Ronald Reagan beginning in 1980 and 1981. And we got on what's called the king dollar standard or the pound dollar standard. And basically the U.S. said to the world, look, there's no more gold standard, but we're going to have a dollar standard, and we're going to maintain the purchasing power of the dollar. And all the other countries in the world, all of our trading partners, you can anchor to the dollar, and that's kind of your anchor. And that actually was very successful from 1981 to 2010. You know, that was a period until the very end characterized by very solid growth. We had long expansions in the 1990s, well, the 1980s and the 1990s. This policy was continued through Republican and Democratic administrations. You know, James Baker under President Bush, Bob Rubin under President Clinton, they both continued the sound dollar policy. Well, flash forward to 2010, the U.S. tore up the deal and said to the world, we're going to cheapen the dollar, and you're on your own, meaning our trading partners in emerging markets. You guys have your own central banks. You figure it out. Well, why did the United States do that? This goes back to the earlier part of our conversation, John. The purpose of cheapening the dollar was to import inflation in the form of higher import prices. Everyone assumes that cheapening the dollar is all about promoting exports. It can have a little positive effect on exports, but that's not why the United States and Japan are doing it. By the way, Japan's doing the same thing. That's not why they're doing it. They're not cheapening the currency to promote exports. They're cheapening the currency to import inflation in the form of higher import prices. Remember, the United States is a net importer. You know, whatever benefit we might get on exports, and I think it's small, we import more than we export. And so when you cheapen the dollar, that means we pay more for, you know, clothing, energy, electronics, manufactured goods, all the things the United States imports. Those price increases feed through the supply chain and cause a more generalized inflation, or at least that's what the Fed hopes for. So that was the reason for the policy. That was the beginning of the currency wars. The currency wars have been playing out ever since. They don't have a logical conclusion. The currency wars is, you know, I analogize it to a tennis match between two very evenly matched strong opponents. I mean, the ball can just go back and forth for a long period of time before anything is resolved, and that's the way currency wars are. But it's a very scary period, and it explains a lot of the volatility we're seeing in markets, including gold, because there's no anchor. I mean, for 100 years, from 1870 to 1971, we had a gold standard on and off, but predominantly a gold standard. For 30 years, from 1980 to 2010, we did not have a gold standard, but we had a dollar standard. Now we have no standard. We have no gold standard, no dollar standard, no Taylor rule. There are no rules whatsoever in the international monetary system, so it should not come as a surprise that we're seeing the kind of confusion, volatility, and suboptimal performance we're getting, because that's what happens when you make it up as you go along, which is what the Fed's doing.
Well, you've just returned from a trip to South Africa where you've been focusing on emerging markets and the so-called BRICS, Brazil, Russia, India, China, and South Africa. I'm curious, how is this monetary policy impacting them? And also, how might their response impact us in return?
Well, it's having very deleterious effects. I did just get back in South Africa. I was there for 2 weeks, and I'm actually leaving Monday for a visit I'll be in Warsaw, Vienna, and Bratislava, so I'll be going to Eastern Europe. So I am spending quite a bit of time focused on emerging markets. They don't know what to do. I mean, this goes back to the world without an anchor. Now, the Fed has tried to wash their hands of the emerging markets. The Fed has said in a number of speeches, Chairman Bernanke and others, you know, hey, we're the Fed. We worry about U.S. economic performance. It's not our job to worry about the emerging markets. You guys have your own central banks. You figure it out. So that's kind of what the Fed has said to emerging markets. I analogize it. It's like a drunk driver who runs over pedestrians and then blames the pedestrians for being in the way. That's the Fed's attitude. The Fed's the drunk driver, and the emerging markets are kind of the innocent victims. So, I mean, the Fed says, hey, South Africa, you have a central bank. If you think your currency is too weak, then raise interest rates. Well, how can you raise interest rates when you've got serious unemployment problems? And that's true around the world. And the Fed's being a little disingenuous, a little glib, because, look, the dollar is the world's reserve currency, at least for the time being. I think that's in jeopardy going forward, by the way, but for now it is the leading reserve currency. And these emerging markets and the BRICS and others have substantially all of their reserves in dollars. And the dollar capital markets are huge relative to these emerging markets. When you look at these emerging markets and actually study them, the capital markets are not that big. I mean, you throw $1 trillion at some of these capital markets, that's 100% of the capital market in a place like South Africa. So our dollar capital flows in and out based on hot money, based on Fed market manipulation, just overwhelm these emerging markets. And you're almost inviting them to put on capital controls. The money flows in, and then it looks like the Fed's going to taper. They're going to raise interest rates. The carry trade is I borrow dollars, so I'm short the dollar. I convert it into South African rand or Thai baht, and I buy the local markets, and I make a spread, and I leverage it up, and I make a lot of money. Well, the first whiff of an increase of interest rates in U.S. dollars, which is what the tapering talk was about, you want to get out of that trade. So you dump the emerging market stocks and currencies. You pay off your dollar loans, you get out of the trade. Well, that's just, money piling in and the money piling out. So these markets can't absorb this kind of inflows. And so one of the dangers the Fed is facing, they may trigger an emerging markets crisis, not unlike what happened in 1997, starting in Thailand, which got out of control, spread around the world. There was blood in the streets of Jakarta and Seoul. It ended up affecting Russia and Brazil, and of course the famous collapse of the long-term capital management hedge fund, something I'm very familiar with. I was very involved in that fund and that bailout at the time. So the Fed's really playing with fire. I think it's disingenuous of them to ignore the impact they're having on emerging markets. Emerging markets don't know which way to turn because they're dependent on the dollar, and here the Fed is manipulating the dollar, which means you're manipulating every market in the world. So I have a lot of sympathy for their position. We'll see how it plays out. In some ways, they're vulnerable. It wouldn't surprise me to see some of these countries putting on capital controls, although that's politically hard. I mean, the money kind of feels good when it's coming in. It's like drugs, and then you feel pretty bad afterwards when the money goes out. That's like withdrawal. So, but it's all a symptom of the Fed manipulation, and I think I'm certain it will end badly sooner than later.
Let's spend a few minutes in conclusion looking at this from an investor perspective. Jim, you've predicted another liquidity crisis similar to 2008 but larger, and I have a particular question. What impact you feel this next liquidity crisis could have on investment portfolios, particularly portfolios that are entirely based on paper assets, portfolios that have no precious metals? What's the outlook in the next crisis for those kind of portfolios?
Well, they're extremely vulnerable, and here's why. First of all, I do expect this crisis because all the conditions that existed in 2008 exist today, except they're bigger, worse, and more dangerous. The too big to fail banks of 2008 today, those same banks are bigger. They have a larger percentage of the banking assets. They have larger derivatives books. Nothing in Dodd-Frank or regulation sense has made any of that any safer. The regulators and the bankers themselves are still using the wrong models. They're using these value at risk models, which are completely illusory. And so you've got a worse situation, a more dangerous situation, greater embedded risk, and continued failure or misapprehension of the statistical properties of risk. So putting all those things together, you can see the next crisis coming. Now, here's the thing. The last time there was a crisis, the Fed dealt with it with massive money printing, trillions of dollars of printed money and swap lines and guarantees and all kinds of other things. Now, the Fed has created several $1 trillion in the last several years without a liquidity crisis. We had a liquidity crisis in 2008, but QE2 and QE3 were not in response to a liquidity crisis. That was trying to stimulate the economy, and of course we'll look back on that and see it as one of the greatest failures in economic history. But the Fed has destroyed its balance sheet. I mean, they look like a really bad hedge fund right now. So what's going to happen when the next liquidity crisis comes? The Fed has used up its dry power. I mean, they've taken their balance sheet. They're approaching $4 trillion. What are they going to do? Go to $8 trillion, $12 trillion? I mean, they can't. They'll be at the limit. So next time you have a crisis, it'll be worse, but it'll be bigger than the Fed. The Fed will not be able to respond to it because they've already printed so much money in a non-crisis environment. They're not going to have any dry powder for the crisis. What does that mean? By the way, the other central banks are in the same situation. UK, Bank of England, Bank of Japan. They all have trashed their balance sheets. So the only clean balance sheet left in the world is the IMF. And so when the next crisis comes, you will reliquefy the world by printing SDRs, these special drawing rights. This is the IMF world money. Well, the purpose of that could work, but because no one understands it, but that will be highly inflationary in dollar terms. And so that's just going to destroy capital formation, destroy the real value of dollar-denominated assets. And the only shelter in the storm is going to be hard assets, which will be, gold, silver, fine art, land, things of that kind. So the smart investors are positioning that way, and so are the big guys, so are Russia and China.
Well, as we wrap this up, can I ask you to clarify the role of gold in the two scenarios we've talked about, inflation and deflation? With inflation, the picture's rather clear. Prices go up, currencies weaken, and gold strengthens. What happens in deflation? If prices drop, presumably gold drops too. Are gold investors then in trouble?
Well, if deflation gets out of control, which it might, it's not my central case, but I absolutely can't rule it out. It is a danger. If deflation gets out of control, you'll see gold come down in nominal terms. From, let's say it's 1350, 1400 now, that could come down to, 1,000 or even lower in nominal terms. But everything else will come down too. I think it's important for investors to understand nothing happens in a vacuum. The world of $900 gold is also the world of, maybe 6,000 on the Dow or 500 on the S&P. Everything else is going to be coming down even more in that extremely deflationary world. So gold could go down in nominal space, in nominal terms, but I still like it as an investment because everything else will be going down more, and gold will still preserve your wealth. But then as it really gets worse, if deflation really takes off, just look at 1933 for an example. What did the government do when we were in the grip of extreme deflation? The government revalued the price of gold higher. Took it from, this is 1933, the government took the price of gold from $20 an ounce to $35 an ounce. It wasn't the market taking gold higher. The market wanted to deflate. It was the government taking gold higher in order to cause inflation. And the reason the government did that in 1933 was not because they wanted gold to go up, but because they wanted everything else to go up. They wanted the price of cotton and oil and steel and wheat and all these other things. So by cheapening the dollar against gold, they caused the inflation to get out of the deflation. That could happen again in a period of extreme deflation. The government could unilaterally take the price of gold to $3,000 or $4,000 an ounce, not to reward gold investors, although it would, but really to cause generalized one-time hyperinflation. So the world of $4,000 gold, all of a sudden, oil's $400 a barrel, silver's $100 an ounce, gas is $7 a gallon at the pump, etc. It would break the back of deflation. So even in extreme deflation, gold will end up going much higher because the government will force it in order to cause inflation because the government cannot have deflation for the reasons we discussed. So this is why gold's funny. I mean, it does well in inflation and deflation, but it's volatile and it's a tough path and it's a very difficult thing for investors to understand. But at the end of the day, gold is money. If you want money, you should have some gold.
Well, let me ask you one last practical question. When gold does go up in either scenario, will there actually be the gold there for people to buy?
Well, that's a good question because there will be physical shortages. The bullion banks and the very large investors and others should be able to get gold directly from the refineries in very large quantities, but the small investor will not be able to get physical gold. I mean, it won't be a question of price. You see the price go up to $4,000 an ounce, and you say, "Oh, gee, inflation's out of control. Run down to my gold dealer, buy some American Gold Eagles or a couple 10-ounce bars or something." They're not going to be able to find it. There'll be physical shortages at that point because all the big guys will have locked up all the gold. So, the prudent thing is to buy, kind of buy the dips, buy gold now, have it in a safe place, and when the day comes, you'll be fine.
Well, thank you, Jim Rickards. We greatly appreciate having you with us today, and thank you to our listeners. Let me once again encourage you to get hold of Jim's book, Currency Wars. It's an illuminating and very readable roadmap to the current global crisis. And I want you to know that Jim has a new book coming out in April 2014. It's called The Death of Money, The Coming Collapse of the International Monetary System. So look forward to that. And meanwhile, on behalf of Anglo Far East and Physical Gold Fund, goodbye for now, and I do look forward to joining you again soon.